The Dow Jones Industrial Average just hit an all-time high. At the same moment, the Nasdaq 100 was falling. That split tells you something important about where money is moving right now. The Dow's record close reflects continued investor confidence in large diversified companies, the kind that span finance, healthcare, energy, and consumer goods. These are businesses with steadier earnings, less exposure to the volatile forces currently hitting the technology sector. The index has 30 components, and right now, that broad mix is working in its favor. The Nasdaq 100 is a different story. It is heavily weighted toward technology, and on this session, semiconductor stocks came under significant selling pressure. Chip stocks dragged the index lower. A sharp reminder of how concentrated the Nasdaq's risk can be when one sector moves hard in one direction. So why are chip stocks under pressure? They sit at the crossroads of several major themes at once. There is the global build-out of artificial intelligence infrastructure, which has driven enormous demand for semiconductors, but also enormous expectations. There are trade policy concerns and export controls, which can disrupt supply chains and cut off key markets almost overnight. And there is the broader consumer electronics cycle, which has been uneven. When any one of those factors turns negative, investors tend to reprice the entire sector quickly. What you're watching here is a rotation. Money appears to be moving away from high-growth, high-valuation technology names and toward more traditional sectors. This kind of rotation is not new. It has been building for some time. But when it accelerates, two major indexes can move in opposite directions on the same day. That is exactly what happened here. Interest rates are an important part of this story. Rates are still elevated by historical standards. That matters because high-growth tech stocks are what analysts call long-duration assets. Their value depends heavily on future earnings, which become worth less in present terms when interest rates are high. More traditional, value-oriented stocks are less sensitive to that dynamic. So as long as rates stay elevated, the Nasdaq faces a structural headwind that the Dow does not. The Federal Reserve's next moves will shape how this plays out. If rate expectations shift in either direction, the gap between Dow and Nasdaq performance could narrow or widen further. The key question now is whether the weakness in semiconductor stocks stays contained or spreads into broader tech selling. If buyers step in and stabilize the chip sector, the rotation may slow. If the selling widens, expect more days where the Dow and Nasdaq tell very different stories. Watch the semiconductor names closely. They are the canary in the tech sector right now. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.